Welcome back. In today's Making Money Now segment, we're shopping from multi-caps. Eric Barden is portfolio manager of the Texas Capital Value and Growth Fund. This is a four-star fund on Morningstar. It is up more than 12% in 2005, and over a three-year period, it has an annualized average return of 31.6% and an 18.5% return over the last 5 years. Joining us now is Eric himself in the studio. Nice to have you with us, Eric.
Well, thank you for having me.
First, let's talk a little about what went on overnight and this morning in international markets. We had a pretty good sell-off in Japan overnight. Did that concern you? I know you've got money all around the world. Did it impact you?
Not too much. Our exposure in Japan is more in the industrials, names such as Kubota. My sense is that Japan was probably due for some kind of a pullback, and I think what you saw overnight was a reversal of some of the run-up in the growth stocks that we've seen so far this year.
So how do you invest around the world? I mean, is that an area that you think is turning around? I mean, do you look at country-specific or stock-specific? How do you do it?
Well, we really don't make too much of a distinction between companies or between countries. We're actually looking for companies that are outperforming in terms of earnings growth, as well as companies that have attractive valuation opportunities. And what we saw, I think, over the last couple of years were some of the international names being neglected. People had been focused on the United States during the late 90s and early 2000s, and we saw valuation opportunities internationally, which coincided with very robust earnings growth. So we were very attracted to a number of companies internationally, but it doesn't have as much to do with the specific country. It's really more about the individual company.
You're saying a lot of interesting things. First of all, outperformance as far as earnings are concerned. What is outperformance to you? What is an appropriate growth level in terms of earnings year over year for a company? What would attract you?
Well, it really depends on the valuation. So if you have a company that's trading at a very low valuation, then a fairly low earnings growth rate could still be an attractive stock. But to the extent that you have more fully valued companies, then you want a robust earnings growth rate. Currently in our fund, we have generally on average about 30% earnings growth, trading at about 14 times earnings. So what we're looking for are undervalued growth stocks. We're trying to find the area of the market where valuation opportunities and growth opportunities both exist.
That sounds pretty good. 30% earnings growth, and you've got a PE of 14. That's certainly a pretty good situation. Give me your picks here in the United States.
Well, we currently favor a company called Black & Decker, as basically it's a household name, and we expect that Black & Decker earnings should continue to perform well, as with real estate appreciation slowing somewhat, individual homeowners are looking to extract equity out of their home. The best way for them to do that right now is actually improving their home.
What if the housing market, though, slows down?
Then it puts even more pressure on them to actually improve the value of their home, which should support Black & Decker's earnings.
And valuation's okay here? Would you commit new capital at this level? It's had a pretty good run-up.
We think so. We think it's probably fully valued somewhere around 110, 120.
Eric, good to have you with us. Thanks so much.
Thanks for your time.
Eric Barden here in the studio with us. And for more on Eric's picks, go to our website. We've got a number of exclusive recommendations you can find only on our website, cnbc.com on MSN.
And we